If you're tracking your wealth, your savings, or maybe you're just thinking about the impossible math of future mortgage rates, you already know something.
Hmm.
The most powerful force in your financial life isn't Congress, it's the Federal Reserve. They really do set the pace for the entire economy.
They absolutely do.
So we're focusing today on a really critical scheduled policy change. On December 1st, 2025, the Fed is slated to end what they call quantitative tightening, or QT.
Right.
Now, put simply, this is the Fed signaling a major shift. They're moving away from trying to pull money out of the economy and potentially moving back towards stimulating markets again as we head into 2026.
And this isn't just, financial jargon.
No, this is a direct signal that affects every single dollar you earn and save. Okay, let's unpack this.
This is one of those moments where being well-informed truly separates those who benefit from economic policy from those who are, left struggling just to keep up. This policy flip, it's going to affect the stock market, the liquidity of banks, and maybe most importantly for you, the path of future inflation and mortgage rates.
So what's our mission for this deep dive?
We want to synthesize the sources available to us. First, we'll define the tools, quantitative easing, QE, and quantitative tightening, QT.
Okay.
Second, we have to analyze what happened last time, the consequences of the last cycle of this, because history is absolutely repeating itself here.
It always seems to.
And finally, we'll explore the 3 core reasons why the Fed is making this major pivot now, even with the risk of, reigniting inflation.
Right, and to really get why ending QT is such a big deal, we have to start at the beginning of the cycle.
With QE.
Exactly, with quantitative easing, or what a lot of us just call money printing. The most dramatic, the most recent example of this was, of course, the pandemic, March 2020.
Oh, yeah?
The Fed launched this massive QE program, effectively creating trillions of new dollars and just injecting them directly into the economic system.
And it wasn't subtle at all.
No, we all saw it. Stimulus checks, expanded unemployment, those PPP loans for businesses that basically turned into grants.
Right. They didn't have to be paid back.
The goal was to stabilize everything, and it definitely boosted the stock market almost instantly.
And this is where the scale of it all becomes truly shocking. It's where we see the true cost of what felt like free money.
So let's look at the numbers.
You have to look at the government's balance sheet. From 2020 through 2021, the U.S. government brought in about $7.4 trillion in tax revenue.
Okay, so that's the money the economy actually generated.
Exactly. But during that same time, total government spending, including all that stimulus, was about $13.2 trillion.
Wow.
So if you do the math on that, that's a $5.8 trillion difference. That's the borrowing gap the Fed had to fund by creating new money.
So they printed $5.8 trillion.
They printed it just to cover the gap between what the government spent and what it actually took in.
$5.8 trillion. I mean, that number is just staggering, and it has to have fundamentally changed the value of the dollars we all held.
Precisely. Think of it like a pie. Suddenly you double the number of slices, but the pie itself hasn't gotten any bigger.
Each slice is worth less.
Exactly. That's what happened to the dollar's value. And initially, a lot of policymakers were arguing this wouldn't cause inflation because the economy was slow.
They were proven dramatically wrong.
Completely wrong. The sources we've reviewed are all unified on this. This event created massive, long-lasting inflation. It made that flood of free money the most expensive kind of money the average person has ever had to deal with.
Okay, so that massive wave of inflation eventually forced the Fed's hand. QE ran from 2020 into early 2022.
Right.
And once inflation became impossible to ignore, they reversed course. They started hiking interest rates like crazy, and they launched the policy we're here to talk about. Quantitative tightening, QT.
The countermove.
Right. We said QE is the Fed buying assets to inject cash. QT is the complete opposite. It's removing money from the system.
And the mechanism is key here.
Yeah, QT is the process of the Fed selling off the assets it holds, mostly government bonds. When the Fed sells a bond, the buyer pays for it.
And that cash is just poof.
Yeah.
It's removed from the commercial banking system. It shrinks the money supply.
A deliberate attempt to fight that inflation they created.
Exactly. And if we look at that period from 2020 through to today, the consequences of that initial money printing really defined the winners and the losers of the last few years.
It kicked off a major wealth shift.
A huge one, and it continues to deepen. The main consequence of high inflation is that some people get significantly richer, while the majority, they experience a sharp decline in their purchasing power.
So if your salary didn't jump, 30% in the last 4 years, you are mathematically falling behind.
You are. Inflation made rent, groceries, travel,
Mm-hmm.
everything so much more expensive that a bigger chunk of your paycheck just goes toward basic survival.
Leaving less or maybe nothing to save or invest.
That's the reality for most people.
This is where I want to pause and just be a little skeptical for a moment based on this pattern. If the sources clearly show that the average person got poorer from the last QE cycle,
Which they do.
why are the authorities willing to pivot back and risk that whole inflation spiral again? Aren't we just setting up for higher costs for everyone again in 2026?
That is the central and very uncomfortable question. The Fed has what's called a dual mandate: maximum employment and stable prices.
And right now, those two things are in conflict.
They are. And when they conflict, policy tends to favor stabilizing the financial system and ensuring liquidity, which often benefits asset owners first.
Okay, so to get why that happens, we need to follow the money.
You have to look at how the money flows between the three main entities in the research: consumers, businesses, and investors who own the businesses.
Let's do that.
Well,
So that first wave of stimulus cash gets printed. It flows into the economy. Consumers spend it at businesses.
right, at Amazon, Chipotle, your local mechanic, wherever. Consumers create the demand.
But when that demand swells and there's so much money floating around, prices go up. I love how the source material put it. That guac becomes a whole lot more extra.
It does. And all those extra dollars flow into the businesses, creating massive revenue.
But the ultimate winners aren't the workers or even the consumers. They're the investors who own the stock in those companies.
Exactly. Their assets appreciate like crazy because the business is making more dollars, even if each of those dollars is worth a little bit less.
And we have the data to back this up, from 2020 to 2025.
We do. Just look at median income. The median wage in the U.S. is projected to have risen by only about 22% during this entire period.
22%. Okay, now compare that to inflation,
Well, reported inflation for basic goods is around 25%.
which already means wages haven't kept up.
Right. And many people, especially if you're spending a lot on gas, food, and rent, feel a much higher rate. We're talking real costs that feel closer to a 50% increase in monthly budgets.
But here's the absolute kicker. The stock market, the main vehicle for investors, is up around 90% over those same 5 years.
90%. That one figure tells the entire story. Asset values rose 4 times faster than median wages.
So the conclusion is inescapable.
It is. Inflation disproportionately benefited the investor because their assets just accelerated far beyond inflation, while the average person's income got left in the dust. And that pattern is why this next pivot is so important for your financial strategy.
Which brings us to right now. The Fed knows this history. They know the risk of inflation hurting most people. And yet, they are stopping QT.
They are.
They are choosing to risk more money creation in 2026.
So, what are the 3 immediate pressing reasons that are forcing their hand on December 1st, 2025?
Okay, reason number 1 is all about credit liquidity and making sure the banking system is stable.
What's the problem there?
What's happening is that this aggressive QT campaign has been draining bank reserves. That's the actual cash banks hold. And those reserves are now critically low.
They're sitting at their lowest point since early 2020.
Wow. Okay.
And these reserves are the lifeblood of a bank. They're needed to cover big customer withdrawals and, crucially, they're the foundation for all new lending.
So low reserves mean banks get tight with their money.
Extremely tight. It becomes harder to get a mortgage, a car loan, or a business credit line. And that slowdown in credit puts a major brake on economic growth.
So the Fed's hope is that ending QT stops the drain.
It stops the drain. And if they pivot to buying assets again, they immediately credit the bank's accounts with fresh cash, boosting reserves, and, they hope, encouraging more lending.
Okay, that's reason 1. Reason 2 is tied directly to the labor market, which is going through a once-in-a-generation shift.
A massive one.
The source material highlights that October 2025 saw some of the worst layoffs in the last 25 years. And the main driver isn't just a slow economy, it's artificial intelligence.
It's technological substitution.
The scale of this is just profound. We are not talking about slow automation anymore. We're seeing huge companies restructure from, say, 10,000 employees down to 3,000 humans and 7,000 AI agents.
And those agents are taking over real jobs: Tier 1 customer service, basic legal work, data processing, compliance review.
These were the high-volume entry points into the workforce for a lot of people.
The critical thing here is that the Fed's tools, like monetary stimulus, are designed to fix cyclical unemployment, temporary slowdowns.
But AI is causing structural unemployment. Those jobs are just gone.
They're gone forever. So the Fed is trying a massive intervention here. The hope is that if they inject enough cash, businesses will grow so fast they'll be forced to hire more humans for complex roles that can't be automated.
I have to ask, though, how confident are the sources that just throwing dollars at this problem can actually work? It feels like trying to fight a technological revolution with a cash cannon.
It's a huge gamble, and it really shows you how worried they are about the job market. But that brings us to the third reason, which is probably the most immediate for you, the consumer.
And that is?
The intense political and public pressure to lower mortgage rates.
Right.
The Fed has been cutting its main interest rate, the Fed funds rate, through 2024 and 2025. But those cuts haven't really moved the needle on 30-year mortgage rates.
Not in a big way, no. The housing market is still stuck.
And that's because mortgage rates don't just follow the Fed's key rate. They are much more directly influenced by what's happening in the U.S. Treasury market.
That's right. So let's break this down. The rate you pay on your mortgage really depends on two main things. First, the Fed funds rate, which is the general cost of money for banks.
And second, the Treasury rate, specifically the yield on long-term government debt. That's the rate the U.S. government pays when it borrows money.
Why is that Treasury rate so important?
It's the fundamental benchmark for all lending. I mean, think about it. The U.S. government is seen as the risk-free investment.
Because they can always raise taxes
Or print more money to pay their bills.
Yeah.
So a bank, when they're looking at you as a borrower, will always charge you a higher rate than the risk-free rate they could get just by lending to the government.
Always. Okay, so now let's connect this back to QT. Quantitative tightening means the Fed is a massive seller of treasuries.
Flooding the market with supply.
And when there's more supply of anything, the seller has to sweeten the deal.
Right. So the government has to offer a higher interest rate, a higher yield on those treasuries to attract buyers.
And higher treasury yields mean banks make great, safe money just lending to the government.
Which means they have to charge you an even higher mortgage rate to make lending to a riskier consumer worth their time.
This is the genius of the pivot, then.
It is. Ending QT and maybe even becoming a buyer of treasuries again does the exact opposite.
So if the Fed comes in as a massive buyer,
It dramatically increases demand for treasuries.
and with more demand, the government doesn't need to offer high interest rates anymore.
Treasury yields fall. And when banks see their safe return from government bonds go down, it forces them to get more competitive and offer money to you for a mortgage at a lower rate. That is the powerful indirect lever they are pulling to try and unstick the housing market.
So wrapping this all up, what does this mean for you as we head into 2026? If we trust history and the sources, the end of QT on December 1st, 2025 is a huge signal.
It signals a return to money stimulation.
And continued inflationary pressure. We saw that the last cycle of money printing diluted the dollar, created inflation, and dramatically benefited investors over savers and consumers.
Understanding this mechanism is not optional anymore. It's critical if you want to protect your financial future.
From the inevitable dilution of your savings.
To just quickly recap the Fed's goals here, 1, shore up bank liquidity to keep the system stable. 2, stimulate the job market hard enough to hopefully overcome AI displacement. And 3, use the treasury market to bring down mortgage rates.
But the big picture trend is clear. It's unchanged. Wages keep lagging behind costs, and inflation inherently hits the non-investor much harder than the asset owner. The overwhelming takeaway from the data, again and again, is that if you are not positioned as an owner, an investor, you are falling behind in this kind of economic environment.
The fascinating and frankly a little daunting context here is that this massive financial policy shift is happening at the exact same time as the largest technological disruption we've ever seen.
It's a potent combination.
Traditional entry-level skills are being automated by AI so fast, shrinking that pool of good median income jobs.
Mm-hmm.
And at the same time, the Fed is pushing policies that historically funnel money toward asset classes, toward investments.
Right.
Based on the trajectory we're seeing in the research, this dynamic is expected to create a tremendous number of new millionaires in the coming years,
Yeah.
but only for those who adapt quickly.
That's the key. It means the winners will be those who figure out how to transition from being a recipient of a shrinking wage to being an owner of growing assets. And that applies whether you're working a job or running your own business. That adaptation is the fundamental challenge of 2026.